Hello and welcome to Acclime's podcast series Advancing Vietnam with me, Vlad Savin, as your host. Throughout the following episodes, we're looking to answering relevant questions about doing business in Vietnam. What are the opportunities and challenges faced by investors entering the market or existing players in major industries? We will seek to understand the business environment from a cultural, local mindset and how to deal with compliance from an international perspective. What are the major risks faced by businesses active in the region and how to overcome them? We will dive deep into the compliance environment in Vietnam, discussing processes and procedures, changes in laws, latest official updates from the authorities, and financial governance planning for businesses active in Vietnam. We at Acclime consider compliance a major asset for foreign investors operating in Vietnam. We emphasize this aspect when speaking with our clients, and we make sure they understand the significant benefits of being compliant. In this episode, I'm discussing with Matthew Lourey, managing partner at Acclime Vietnam, about how individuals that are working, investing, or living in Vietnam can assess and understand their personal income tax obligations, looking at types of taxes, thresholds, available deductions, and specific provisions which they should be aware of. Matthew, welcome to our 12th episode of Advancing Vietnam podcast series. Good to have you here.
Thank you, Vlad. Looking forward to talking about matters that are more personal, and personal taxation is always something that's worth talking about.
Indeed. Matthew, in Vietnam, the tax system can be at times confusing and tedious, involving procedures and calculations that are complicated and hard to comprehend, particularly for expatriates and foreign individuals that have no technical knowledge on personal income tax rules and regulations that apply to salaries, wages, or other income sources. Let's start first with the generic question. What is personal income tax?
So I'll actually step back one step further than that. The Vietnamese personal income tax structure concepts are not too different to many other countries. So we're not talking about something unique to Vietnam here. It's quite a generic topic. Vietnam is not unusual. So personal income tax is a tax paid by the individual on their income they earn. It's personal tax, taxed on the individual. It is usually withheld by the employer when they're paying money, but it can arise in a range of circumstances. But it's an obligation on the individual who earns money. If you earn income, it needs to be taxed, your personal income, your personal tax.
And individuals based in Vietnam are taxed based on residency, meaning that depending if they are resident or non-resident in Vietnam, different tax rates may apply. And before we delve into the taxation element of the discussion, can you explain the difference between a tax resident and a non-resident in Vietnam?
Yeah, so tax residency is probably one of the least understood concepts, and it's important, you're right, to get it done at the start. So tax residency is something determined by the country that it's relevant. So you can't just make a decision based upon another country's determination. If Vietnam says, if you reside in Vietnam more than 183 days in a year, or if you have a temporary or permanent resident card, or you are a Vietnamese national, or you are renting a property more than 183 days, the Vietnamese authorities deem you to be tax resident. That is, you are subject to global taxation in Vietnam. A non-resident is someone who does not meet those criteria, someone less than 6 months in the year in Vietnam, then they would only be taxed in Vietnam on their Vietnam-derived earnings. So the residency is your global taxation or whether you're subject to only earnings on there. Double tax agreements, when we can talk about those later on, can complicate things. And there is one more part about tax residency. The fact that you might be less than 183 days, but if you can't prove you're tax resident somewhere else, then you may still be deemed tax resident in Vietnam. The last part about that is that people often assume, oh, I'm tax resident somewhere else, I can't be tax resident in Vietnam. The Vietnamese authorities, and there are tiebacker provisions probably in double tax agreements, but Vietnamese authorities have no direct relevance to what other authorities. They will deem you based on Vietnamese laws, and that's all that's relevant in Vietnam because you're subject to Vietnamese law. So what an individual is in the home country should not be the determining factor in someone's mind that they are tax resident or non-resident in Vietnam.
And moving from that, how can individuals assess their taxable income? Or in other words, what is the total income that will be subject to taxation in Vietnam?
Yeah, so that if you are tax resident, it's any income you earn globally. Now, the double tax agreements may give certain taxing rights, it may be exempt or may be taxed differently in Vietnam. However, your basic premise, if I get your question right, is that any income, if you're a tax resident, is taxable in Vietnam, whether it's taxed as salary or professional services. It could be taxed at different rates, but it's taxable. If you're a non-resident, only income that you derive in Vietnam. To assess it, you need to work out what source of income, and there are various rates applies, and we can go through some sort of scenarios again, but you have salary income, and most personal income is taxed on a rate which goes from 0 to 35%, the top rate. Certain other business income might be taxed at 5 or 10%, depending on what it is. But and income on property is taxed at, you might have a 10% tax on property income. There is various 5% tax on dividends that exist, but ultimately, it's where it's derived is the most important factor.
Mm-hmm. And can you share a few examples on individuals who were taxed by the authorities based on their worldwide income and the implications here? In particular, maybe for freelancers, there were a couple of news articles with freelancers and digital nomads doing business here in Vietnam, working on for YouTube videos or for Facebook ads. And in the end, the government, I think it happened in 2020, they started looking into their income and their taxation.
In 2019 they started going to banks and finding out those who were earning income from foreign sources, particularly Google ads, YouTube revenue, Facebook revenue, to seeing where the income's coming from and tracing the income down. So they're levying them. Now that may not be levied as the highest rate personal income tax for professional services. It might be a business income and a lower tax rate, but it is still taxed to the individual that earned that income. And they did go down and chase and say that it doesn't matter whether they were in Vietnam, they earned it, or they were outside or was derived from activities outside. They were tax resident. So they went through a number of the banks and went for looked for all sources of income into the banks that were from those channels. At the same time, we've also seen examples of individuals who underdeclare their salaries, those who are clearly have a lifestyle greater than the income. The authorities will go back through various agreements with other tax authorities, or go through other mechanisms such as embassies and consulates and seek confirmation of worldwide income, including foreign bank account confirmations, and the authorities will deem taxes if they have evidence or suggestions of income being understated. So whether it's a freelancer, whether it's an individual understating, the authorities can reach quite far to make sure that if you are a tax resident, you are declaring your worldwide income, and from any source, both YouTube, freelance, salary, whatever.
When dealing with employers negotiating salaries or income revenue from other sources, individuals should be aware of their taxation requirements. How can individuals calculate their personal income tax in Vietnam? What are actually the standard rates and the potential tax deductions under current regulations?
So employees are taxed at a rate between 0 and 35%. It increases to start at 0, the first 11 million is 0. If you've got dependents, you add 4.4 million dong, this is per month, to that. Then it goes 5%. Then after the next 5 million dong, it's 10%, and it goes up to 35%. So it's a progressive rate, the scale that exists there, and it's published rate. You can work out what's my gross income, and then therefore what's the tax that is to be deducted from my gross income using those rates. Our website, we have a link to those. There's a quick guide you can download. It's quite common, you can Google that information. It's a published tax rate. So the employer is responsible to calculate and withhold. They are required to give you pay slips. It will be disclosed in the pay slips. At the end of the year, they can do things. You can get documentation of withholding. It is public. So it's not some secret formula that gets applied that you don't know about. It is a prepayment of your taxes. They are withholding your taxes and remitting to the government at the end of the year. If you have paid too much or not enough, you are responsible for the difference. And it is, even though people ignore it often because they don't ever get to see the money, the obligation actually is a personal income tax on the employee, on the individual, just that the employer withholds on the government's behalf.
Mm-hmm. And except salary, what other, common thresholds for various types of income exist here and are relevant maybe for individuals in Vietnam?
Bank interest income is actually tax exempt, but income from non-bank sources is 5%. Dividend, it's 5%. You can have certain business income can be subject to 10% tax or a 5% tax. It actually is quite varied, so it's hard to give a complete summary. It's something that you need to look at before you start earning income, but the standard type of things that people do, interest in dividends, etc., is quite a low. But that's taxed. Keep in mind that that's a withholding tax. It's withheld from source. You don't get any other deductions. So unlike many countries where you can lodge your return and claim a deduction for self-education costs, training costs, uniforms, etc., you don't have the ability to do those deductions. You have to either there can be a benefit provided by the employer, or you just have to pay your tax on your gross. You don't get to net and do calculations. So that's probably the easiest way to explain it.
Before the implementation of the new labor code in 2019, service contracts were previously used by individuals as a short-term option to replace a labor contract, which required a different threshold of taxation provisions. Under the new labor code, which is implemented on 1st of January this year, how do service contracts work, and what are the potential tax liabilities here for individuals?
I will say that service contracts historically were commonly used and not necessarily used properly. I do have the opinion that a lot of service contracts that existed in the past were likely to be employment contracts in another name. The new labour law, as you mentioned, has made it very clear that the vast majority of service contracts are employment contracts from prima facie from the start, and that trying to use that as a loophole to make employment easier or to deal with things is now gone. Now, if you look, first of all, resident, non-resident. So if you are using a service contract and if it's valid and you're a non-resident, there's 20% with tax, fixed tax on, if you're a non-resident, on your income, 20%. If you're a resident and it is a service contract, i.e. you are providing something that's not the provision of labour, but it might be results-based, might be commission-based, etc., you'll have a 10% withholding. So the 10% withholding is a prepayment. It's not the actual tax that will apply to the revenue. It's regarded as a prepayment of tax. It's built around, is that business income or is it personal services income? So they don't just whack the full tax rate on there or a lower tax rate. It's a blended rate to account for maybe different types of income. So a 10% is withheld for a payment under a valid service contract. If it is an employment contract, then honestly most service contracts now are employment contract under the law, then the normal rate of 0 through to 35% would apply.
And what about tax finalizations? How can individuals undertake these, and when? Can they authorize a third party to submit them on their behalf, or they should do these themselves as individuals?
Okay, so employees are required to finalise their taxes after the end of each calendar year. So your year end 31 December, you've got till 4 months to finalise. It was 3 months, now you have 4 months to finalise. You're only legally required to finalise if you owe money or are owed refund. However, if you don't finalise in a year, if you wish to claim a refund in future years, it becomes quite difficult and you may need to go back. So the general rule is finalise every year for safety. You can, if you've only got one source of income through your employer in that year, you can get your employer to finalise for you. And that's the most common way in Vietnam, is the employer will finalise. If there's a refund, they will receive it and remit to you as part of your salary payments. If you have multiple sources of income, or if you just like to do it yourself, you can. Your local tax office there's a process for lodging. It's a process that will be difficult for foreign individuals to do because of the language and the forms. However, it can be done yourself. So if you've got either a tax agent, you can appoint an agent. If you've got more complicated income, foreign income, multiple sources, the documentation requirements can often be imposing and start causing frustration. So someone who's experienced in what the authorities want, what form it must take and how to lodge it is probably going to become much more relevant. If it's very simple taxes, then it is possible to do yourself. Just be aware that unless you have dealt with it before and know the forms and know the process, a number of visits may be necessary, because Vietnam is paper driven and it is evidence driven. It's not like many countries where it's an online self-declaration. This is an evidence-based report, and if your documents don't match within their system, a lot of it's in the system, they won't accept the documents until they match.
We talked a lot about tax. Let's see if there's any benefits around this subject. Can individuals take advantage of non-taxable benefits, which are essentially excluded from the taxable income of the taxpayer? Do you have a few examples of such benefits?
So There are some. There's actually quite a few more for foreign individuals. It's one of those things in the labour law where, provided they have a work permit and therefore legally employed or an exemption certificate, foreign individuals can avail themselves to a wide range of extra benefits. But you've got things, just fundamentally, you've got things such as there's uniforms, there's meal allowances, they're subject to caps and subject to limits. Private health insurance subject to limits. There's certain ways you can do, and they're quite common. Someone can be provided a car for business purposes, so to and from the office, travel around during the daytime for working. Those sort of benefits are fairly standard. Mobile phone for work purposes, of being business related and not...
School fees as well?
Well, that's when you start getting into the foreign individuals, where foreign individuals have specific benefits. School fees, K-12, for foreign employees, where that benefit is provided, not cash, so it's not an allowance, it's not a reimbursement, it needs to be a provision of a benefit. So if the school provides the schooling, i.e. pays the school fees direct and receives the invoice, that is a provision of a school benefit, and that is exempt for foreign individuals with a work permit. The same thing goes for one flight home per year for a foreign individual, so the flight to arrive in Vietnam is exempt. The one return flight home per year for the individual, not for the family subject to taxes. You've also got there's a housing benefit. So up to 15% of your income, if the housing benefit doesn't exceed 15% of your income, the excessive amount can be tax-free. So you've got potentially an 85% ratio of housing that you can look into package, provided again the benefit is provided, not an allowance. So housing allowance is a taxable income. A provision of a housing benefit where the employer pays the rent, receives the invoice, it's in their name, that would be tax-free. You've got to be careful because VAT needs to be added, where if an individual is renting private arrangement, VAT may not apply. So there's some calculations to do. That can be very beneficial in many cases. They're the main ones. There is another one there that if someone receives like a golf membership, that golf membership will be taxable if it's allocated to them, if it belongs to a person, if it's a right in the labour contract, if it's in the internal labour rules, it's taxable. However, if it's not a right, if it's simply there's a membership and you're just using it as an employee, but it's not allocated to you or a right, it's not taxable. The same applies back to all the other benefits. If they're not stated in internal regulations or labour contracts, etc., there's a problem where they may not be tax deductible to the company and they may be not exempt as an exempt benefit unless they're documented accordingly. So the documentation is really, really important in these situations.
And finally, where individuals would like to take advantage of certain double tax agreements between Vietnam and other countries, how can they apply for these DTA provisions?
Yeah, the double tax agreement I touched on earlier is an important document. So Vietnam has around 80 double tax agreements with most trading partners, not with the US. There's a draft one. It was never ratified, so just really be careful of that. But most countries, it has double tax agreements. So a double tax agreement is a international agreement between two countries about how they would treat taxation. And there's a standard structure for how it talks about personal services income, fixed property income, business income, and taxing rights and residency. Now, by default, the DTA might sound like, oh great, international law is always higher than a domestic law, but by default, the domestic law applies. You must invoke the DTA. And the Vietnamese authorities have a specific path for invoking. So some things may be able to be applied, such as which income is taxable where. If it's fixed property income, it may be primary taxable in a certain country, or there may be a provision about if you're in a country earning income, income's taxed there. If you're a resident of the other country, taxing rights still gives to certain countries. There are different ways they're written. But if you want to choose or apply or seek to use like the tie-break provisions on residency, if you are tax resident by domestic laws in two countries, you may go to the double tax agreement and say, okay, under the agreement, if I'm tax resident in both, this is the process and therefore I would be Vietnamese tax resident or not Vietnamese tax resident. You would need to apply to the authorities, there's a process to apply to the tax authorities to seek application of the DTA provision that would apply to you. So in many of these situations where you're seeking to use one of them to your benefit, you will need to apply in advance prior to using it or prior to that tax year being finalised. And it's different for each part of it, how it works. The key to that is Don't assume that DTA is there to protect you. You may be too late to invoke it, or it may not be relevant according to the authorities. So before you are earning income, or if you're a tax resident in a different location and you are earning income or wanting to do something, plan ahead. Get some advice. Look at the DTAs who may look simple in text. They're complicated to apply, and you've got to look at it from both sides. And it becomes an expensive process in many cases because you need to involve potentially tax advisors in multiple countries. But making the application to apply DTA can also be very beneficial. It can remove the liability for tax in certain countries, and it may eliminate tax residency or double taxation in many situations, so that you're only taxed once in one country, get a credit in some other country, but you're not taxed twice, which is where there's no double tax agreement, and particularly the US Vietnam, you can easily be taxed primarily twice. Once in Vietnam, once in USA. You can apply for a credit, but you're actually applying to refund tax that you've already paid, as opposed to if you can use a double tax agreement, you would generally only pay tax once.
Matthew, thank you again for your practical advice. Unfortunately, our time is up.
You're more than welcome, Vlad. I enjoy doing these sessions with you.
So taxation in Vietnam is a subject often misunderstood due to its complicated provisions and compliance requirements. However, individuals working and living in Vietnam should constantly stay informed about regulations and changes and understand not just their tax obligations, but also the potential benefits and opportunities that may arise in the future. And many thanks to you, our listeners, for tuning in to Advancing Vietnam podcast series. For more information about this topic, please check out our publications on vietnam.acclime.com. And if you want to reach out to us for any additional details, feel free to contact me on LinkedIn or throughout the website contact details.